You're listening to All Things Investing, the podcast that makes money talk simple, smart, and actionable. Whether you're just getting started or leveling up your portfolio, we've got you covered with tips, strategies, and no-fluff advice. Let's grow your wealth, one episode at a time.
So imagine you kept $10,000 in a quote-unquote safe savings account for the last 20 years.
Right, just sitting there in cash.
Yeah, exactly. You probably think you did the responsible thing, but you actually didn't preserve your wealth at all.
Not even close.
Thanks to the tandem forces of taxes and inflation, you mathematically guaranteed its destruction. You basically locked away your purchasing power and got a fraction of it back 2 decades later.
It's a harsh reality to wake up to.
It really is. And today we are doing a deep dive into an expansive stack of financial guides. We're looking at compilations from ATI, iShares, Western and Southern, and TD Canada Trust.
All really solid sources.
Yeah, and we're using them to show you exactly why absolute safety is actually the riskiest financial move you can make.
It's a profound paradox, honestly, because the financial services industry has spent decades, arguably centuries, building this massive architecture of intimidation.
Oh, for sure. The jargon alone is terrifying.
Exactly. They use dense terminology, dizzying charts, and there's this implicit cultural message.
Yeah, like it's an exclusive club.
Right. It suggests that if you don't possess a 6-figure salary and a degree in quantitative finance, you just have no business sitting at the table.
Which is the biggest beginner misconception out there. This idea that investing is only for rich people or Wall Street experts.
We are conditioned to look at our paychecks, see the immediate demands of rent, groceries, debt, and we just conclude that investing is a luxury, like it's reserved for people who summer in the Hamptons.
Which brings us to the core mission of this deep dive. We want to completely strip that architecture down to the studs.
I love that.
Because the overarching theme across all of these institutional guides, when you bypass the marketing gloss and look at the raw mechanics, it's incredibly empowering for the everyday person.
It really is. It's so much simpler than they want you to believe.
So we are going to dismantle the jargon. We're focusing entirely on the foundational mechanics of wealth building. Because when you distill it, investing is not about frantic day trading or complex derivatives.
No, not at all.
If we had to explain the absolute bedrock concept of investing to a 10-year-old, or honestly, to ourselves 10 years ago, it is just this.
Let's hear it.
Investing is simply putting a little money aside now so it can grow later. It is exchanging today's money for a chance at more money in the future.
It is the temporal displacement of capital.
Whoa, okay, Mr. Jargon, dial it back.
Fair enough. You are deliberately delaying immediate gratification. You're sending your dollars into the future to perform labor on your behalf.
Sending your dollars to work. I like that.
But the gap between that simple 10-year-old's definition and the reality of how adults actually behave, it's vast. And that gap exists because the industry thrives on complexity.
They sell complex solutions to problems that empirically require incredibly simple, almost boring answers.
Exactly.
So let's challenge that premise right out of the gate. If investing is literally just exchanging today's money for tomorrow's, why are there billion-dollar institutions employing PhDs in applied mathematics?
Right, building high-frequency trading algorithms and all that.
Yeah. Why does the complexity exist at all if it isn't necessary for success?
Well, the complexity exists to capture yield for the institutions, not for the retail investor, you and me.
Okay, so they're playing a different game entirely.
Exactly. Institutional finance operates on razor-thin arbitrage. They're attempting to exploit microscopic inefficiencies in global markets before anyone else does.
And that requires supercomputers.
And the PhDs, yeah. But for the individual trying to fund a retirement or build generational wealth, trying to play that game is like trying to win a Formula One race in a Honda Civic.
You are playing on the wrong track.
Exactly. The data across the ATI and Western and Southern guides points to a really stark reality. For the everyday person, a boring, automated, steady approach almost always outperforms the frantic tactical trading you see in the financial media.
You don't need to outsmart the high-frequency algorithms. You just need to capture the long-term upward drift of human economic progress.
Which is a very comforting thought, honestly.
It is. And that upward drift is where I want to start unpacking the mechanics. Let's look at the foundational why. Because a rational person looking at a volatile stock market might logically conclude something else.
Like they should just save their cash.
Right. They think, I'll just save my money, I'll put my extra cash under the mattress or in a basic checking account. It won't grow, but I definitely can't lose it.
Ah, the illusion of safety.
We need to deconstruct why that instinct, the pursuit of absolute zero volatility safety, is actually guaranteed failure.
This requires us to really examine the concept of inflation. We can conceptualize it as the silent thief of purchasing power.
The silent thief.
Right, because the instinct to hoard cash assumes that money possesses intrinsic static value. But it does not. Fiat currency is just a measurement of purchasing power at a specific moment in time.
So $10 today won't buy the same stuff in 10 years.
Exactly. Inflation is the ongoing gradual expansion of the money supply and the rising cost of goods and services. It continuously erodes your purchasing power.
Let's quantify that erosion, because the Western and Southern Guide notes that historical inflation averages roughly 3% per year.
Which doesn't sound catastrophic on its face, right?
No, it sounds like a mild annoyance at the grocery store.
It sounds mild until you compound it. If historical inflation averages 3%, that means the purchasing power of your cash is being halved roughly every 24 years.
Halved. Wow.
Yeah. If you hide $100 under your mattress today, next year, you need $103 just to buy the exact same basket of goods.
But the math gets significantly more punishing when we factor in taxation, right? TD Canada Trust provides a stark mathematical reality check on this dynamic.
Yes, this is the hurdle rate concept.
Break this down for us, because this is where the illusion of the safe savings account completely collapses.
Okay, let's assume a highly conservative environment where inflation is running at just 2%.
Okay, 2%.
And let's assume your marginal tax rate,
Yeah.
the tax you pay on the last dollar you earn, is 35%.
Pretty standard for a lot of working professionals.
Right. Now, if you place your money in a savings account that generates a small amount of interest, that interest is taxable as income.
The government always takes its cut.
Exactly. Because the government taxes your nominal gains before inflation is accounted for, you have to earn significantly more than the inflation rate just to tread water.
So wait, I have to out-earn the 2% inflation plus the 35% tax I owe on whatever the account yields?
You got it. Mathematically, in that scenario, you need to earn a guaranteed return of 3.08% a year on your money just to break even.
Just to break even. So that is my hurdle rate.
Yes. If you earn 3.08%, you pay your 35% tax on that gain, leaving you with exactly enough to cover the 2% inflation.
Which means my real return is precisely zero.
Precisely zero. Now, consider that most basic savings accounts pay anywhere from 0.01% to maybe 1% in a good year.
So if you are sitting in cash, you are actively mathematically moving backward.
You are getting poorer every single day.
This draws a hard, undeniable line between saving and investing, and we need to be crystal clear on the distinct utility of both.
They are very different tools.
Saving is fundamentally about liquidity and capital preservation in the extreme short term. It is your emergency fund.
Right. It is the money you need tomorrow if your car transmission explodes.
But investing is entirely different. Investing requires you to actively take on a calculated amount of volatility to outpace that 3.08% hurdle rate.
Precisely. Savings provide behavioral security, but investments provide economic growth.
You cannot use a savings vehicle to build long-term wealth because the silent thief will perpetually outpace the yield.
Right. To generate wealth, you have to exchange absolute short-term liquidity for long-term compounding potential.
Let's look at a concrete, real numbers comparison from the materials to illustrate this exact trade-off.
Okay, let's hear the numbers.
Let's assume you have $10,000. You are terrified of market volatility, so you place it in a traditional savings account earning 0.5% interest.
Very typical scenario.
And you leave it there for 20 years.
Okay, so after 2 decades of compound interest at 0.5%, your $10,000 will have grown to roughly $11,050.
So I generated slightly over $1,000 in nominal wealth.
Yes, but when you apply our historical 3% inflation rate to that timeline, the purchasing power of that $11,000 is drastically lower than the $10,000 you started with 20 years prior.
I took zero market risk, and as a result, I suffered a massive loss in real wealth.
Exactly. Now let's look at the alternative.
Okay. If you took that same $10,000 and deployed it into a diversified investment portfolio that returned a historical average of 8% per year over those same 20 years.
And you never add another dime to it.
Never add a dime. You just let it sit and endure the market fluctuations.
At an 8% annualized return over 20 years, that initial $10,000 capital base grows to roughly $46,600.
Wow. A $36,600 gain compared to a $1,050 gain just by changing the vehicle.
It's massive.
Yeah.
That isn't just an incremental improvement. That is a fundamental shift in your socioeconomic trajectory.
And the mechanism driving that shift is compounding.
Yes, compounding is often referred to as the eighth wonder of the world, and for good reason.
It's the mathematical process where the returns you generate on your initial investment begin to generate their own returns, right?
Exactly. Your money makes money, and then that new money makes even more money.
The classic analogy in personal finance is the snowball rolling down a hill.
It's a cliche because it works perfectly.
Right. At first, you are packing this tiny ball of snow, you're pushing it, the friction is high, and it feels like an immense amount of labor for very little visible growth.
But as it rolls, it increases its surface area.
Exactly. The larger it gets, the more snow it inherently captures with each revolution. By the time it reaches the bottom of the hill, its mass is expanding exponentially without any additional physical effort from you.
It perfectly encapsulates the transition from linear to exponential growth.
And the thing is, human beings are notoriously bad at intuitively grasping exponential growth.
Oh, absolutely. Our brains are wired to think linearly. Like, if I walk 1 mile a day, in 10 days I will have walked 10 miles.
Right. We expect a 1-to-1 input-to-output ratio. But compounding breaks that ratio entirely.
Let's look at the ATI Guide's data to ground this in a real-world scenario. They model an investor who commits to putting $300 a month into a broad stock index fund.
Okay, let's assume a historical average return of 7% per year for this fund.
Right.
For the first few years, the growth is entirely linear. It's just the brute force of your $300 monthly deposit.
Just packing the snowball.
Right. But if you maintain that discipline for 20 years, your total out-of-pocket contribution is $72,000.
Okay, 72 grand out of my own pocket.
However, the final balance of the account would be roughly $156,000. So the compounding engine has essentially matched and exceeded my own labor. I put in $72,000 of sweat equity, and the market generated $84,000 of invisible equity.
Exactly. But the true violence of compounding doesn't reveal itself until the later decades.
The violence of compounding, I love that phrasing.
Well, watch what happens. If you extend that exact same scenario by just 10 more years, a 30-year horizon instead of 20.
Okay, so I don't increase my $300 monthly contribution.
Nope. You just let the existing mass continue to revolve. Your total out-of-pocket contribution rises to $108,000.
Right.
But the final balance doesn't just incrementally step up. It balloons to over $360,000.
Oh my God. So in the first 20 years, the market gave me $84,000 in growth. But in the next 10 years alone, the market gives me an additional $204,000 in growth.
Exactly. The timeline is halved, but the wealth generated is more than doubled.
Because the surface area of the snowball is now massive.
Right. A 7% return on $156,000 generates nearly $11,000 in a single year, which is significantly more than your $3,600 annual out-of-pocket contribution.
The money is now working harder than you are. This is the inflection point where wealth is actually created.
It is.
The math is undeniable. But this raises an immediate psychological barrier for you as a listener, because what if you are looking at your budget and after rent, student loans, and groceries, you don't have $300 a month?
A very real scenario for a lot of people.
What if you literally only have $25 or $50 a paycheck to spare? The linear brain says, why bother? $25 a month isn't going to make me rich. The snowball is too small.
And this is where we have to decouple the absolute dollar amount from the mechanical habit.
Explain that.
The mathematics of compounding are blind to the number of zeros in your account. The formula only cares about the percentage rate of return in time.
So the $25 still works.
Right. Is a $25 monthly contribution going to buy you a private island? No. But starting with $25 achieves something far more vital.
What's that?
It establishes the infrastructure and the behavioral habit of automated wealth accumulation.
It sets the snowball in motion regardless of its initial mass.
Precisely. As your career progresses, as your income presumably rises, you can increase the mass you are adding to it, but you cannot retroactively manufacture time.
The power comes from consistency and duration.
Exactly. A few dollars contributed regularly today is worth exponentially more than a large lump sum contributed a decade from now.
Quick break. If you're enjoying all things investing, be sure to follow, rate, and share this episode with a friend who needs to start investing smarter. Got questions? We might answer them in the next episode. Now, back to the show.
There is a fantastic, highly practical mathematical tool for this that completely bypasses the need for complex exponential calculators.
Ah, the rule of 72.
Yes, the rule of 72. It is an essential mental model for anyone trying to conceptualize their financial trajectory.
It's so useful.
It allows you to instantly calculate roughly how long it will take for your invested capital to double based on a fixed annual rate of return.
Right. It's just simple division.
You simply take the number 72 and divide it by your expected percentage return.
So if we look back at our 8% diversified portfolio from earlier, you take 72 divided by 8 and you get 9.
Which means your money will double in purchasing power roughly every 9 years.
And this is where the contrast with cash becomes truly alarming.
Let's do the math on the savings account.
Okay, if we apply the rule of 72 to the safe savings account earning 0.5%, 72 divided by 0.5 is 144.
Wait, 144 years?
Yes. It will take 144 years for your money to double in nominal terms. You would have to outlive several generations of your own descendants just to see a 100% return.
And by that point, inflation will have eroded almost all of its real value anyway.
Exactly. It's a losing game.
The rule of 72 lays out the physics of wealth. You need a higher rate of return, something in the 5 to 10% range, to compress that doubling time into a standard human working lifetime.
You have to get it under a decade, or maybe a decade and a half.
Right. But to achieve that 8% return, to get a 9-year doubling cycle, you have to expose your capital to the open market. And this brings us to the single most paralyzing psychological barrier outlined in these guides.
The fear of loss.
The fear of losing your money. It is the apex predator of beginner investors.
It absolutely is.
And it is entirely rational to be terrified. I mean, you labor for 40 hours a week to earn your money, you painstakingly carve out $300 from your budget, you deploy it into the market, and you wake up on a random Tuesday to see that your $300 is now worth $240.
The visceral reaction is panic.
Total panic. The brain interprets this as an existential threat.
Behavioral economists like Daniel Kahneman and Amos Tversky quantified this phenomenon perfectly. It is called loss aversion.
I love their research.
It's brilliant. Their research demonstrates that the psychological pain of losing $100 is experienced roughly twice as intensely as the joy of gaining $100.
We are hardwired to prioritize the avoidance of pain over the acquisition of pleasure.
Right, so when a beginner sees a red arrow next to their portfolio balance, their evolutionary biology is screaming at them to flee from the predator.
So how do we override our evolutionary biology? How do we intellectually justify keeping our money in a system that occasionally detonates?
We do it by rigorously separating two concepts that beginners constantly conflate: volatility and permanent loss of capital.
This is a crucial distinction. Break down the mechanical difference for us.
Well, when the uninitiated hear the word risk in finance, they equate it with a casino.
Right, betting it all on black.
Exactly. You place your chips on the roulette table, the ball lands on the wrong color, and the dealer sweeps your chips into a void. Your capital is permanently destroyed.
That is permanent loss.
But investing in broadly diversified equity markets is not roulette. In finance, risk is primarily defined as volatility or variance.
Volatility just means the price fluctuates, right?
Right. Volatility simply means the daily, monthly, or yearly quoted price of your asset will move up and down wildly.
It's the difference between the airplane experiencing severe turbulence and the airplane structurally failing and crashing into the ocean.
Exactly. The turbulence is terrifying, your coffee spills, and you feel sick, but the plane is still fundamentally sound and moving toward its destination.
So how do you survive the turbulence without attempting to pry open the emergency exit door at 30,000 feet?
The key is understanding your time horizon. Time horizon is the absolute anchor of risk management.
Okay, define time horizon for us.
It is simply the measure of how much time will pass before you actually need to liquidate the asset to buy groceries or pay rent.
So if I am 30 years old and this money is earmarked for a retirement at age 65, my time horizon is 35 years.
Exactly. And if your time horizon is 35 years, the quoted price of your portfolio on a random Tuesday in October of this current year is entirely irrelevant.
It's just noise.
It is phantom data. The daily fluctuations only matter to the people who are forced to sell on that specific day.
I understand the mathematical logic of the time horizon. If I don't need the money for 3 decades, A 20% market drop today is just on paper turbulence.
Right.
But I want to push back on the psychological execution of this. It is incredibly easy for us to sit here in a vacuum and preach about stoicism.
Oh, absolutely. Theory is easy.
But let's talk about a scenario like 2008 or the onset of the pandemic in 2020. The market isn't just dipping, the global financial system appears to be collapsing.
Banks are failing, unemployment is skyrocketing.
Yeah, the media is running 2047 coverage of economic doom. When the system itself looks fundamentally broken, how do you convince someone that selling isn't the rational, prudent move to protect whatever they have left?
Is the ultimate test of investor discipline. Because the instinct to pull your money out and retreat to the safety of cash during a systemic crisis is overwhelming.
But doing that leads to a huge mistake. Yes.
It leads to the single most destructive behavioral error outlined by Western and Southern, which is attempting to time the market.
Let's define market timing, because the theory sounds perfectly logical to a beginner.
It really does.
The idea is the market is crashing, so I sell my investments now, I hold cash while the storm passes, and when the market hits rock bottom and everything is cheap, I buy back in. I avoid the pain and capture the upside.
It sounds like an elegant solution, but empirically, it is practically impossible to execute consistently, even for institutional professionals armed with those supercomputers.
Why is it so dangerous?
When you succumb to panic and sell during a violent downturn, you commit two devastating unforced errors.
What's the first?
First, you instantly convert volatility into permanent loss. That 20% dip was just a phantom, on-paper fluctuation until you click the sell button. The moment you sell, you lock in the loss. You have legally severed your ownership of the assets at a discount.
You essentially jumped out of the airplane while it was experiencing turbulence. You survived, but now you're on the ground and the plane is flying away without you.
Which leads to the second and mathematically more damaging error. You invariably miss the rebound.
You missed the recovery?
Yes. The greatest myth of market timing is the idea that the market sent a clear, ringing bell to signal the all clear. It does not.
It never does. The news is still terrible when the market starts recovering.
Exactly.
Yeah.
The most explosive days of market growth historically occur in the immediate aftermath of, or even during, the most terrifying periods of market decline.
So if you're sitting on the sidelines in cash, waiting for economic data to look sunny again, you miss it.
You will miss the initial, violent upward surge that drives a vast majority of long-term compounded returns.
I've actually seen studies on this exact phenomenon, the cost of missing the quote-unquote best days.
The data is staggering. If you stay fully invested in the S&P 500 over a 20-year period, you capture the historical average return.
Which is great.
But if you try to time the market and you accidentally miss just the 10 single best trading days over that entire 20-year span, just 10 days at a roughly 5,000, your overall returns are often cut in half.
Cut in half from missing 10 days out of 2 decades. That is wild.
It gets worse. Miss the 30 best days, and your returns can drop to zero or become negative.
Which perfectly illustrates the industry adage time in the market beats timing the market.
It isn't a cliche. It's a mathematical imperative. You cannot predict the 10 best days, so you must be fully invested for all 5,000 days to ensure you capture them.
Time in the market is your greatest shield against risk. Historically, over rolling 20 or 30-year periods, staying invested through recessions, geopolitical crises, and inflationary spikes has reliably resulted in massive wealth generation.
The strategy isn't to outsmart the market. The strategy is to outlast it.
Okay, so we've established the behavioral armor we need. We must outlast the market, ignore the turbulence, and respect our time horizon.
Exactly.
But to maintain that discipline, we need to demystify what we are actually holding during that turbulence. Let's open up the toolkit provided in these guides. What are the actual instruments we are deploying our capital into?
When you strip away the derivatives and the esoteric financial products, the foundation of a beginner's portfolio rests on two primary asset classes.
Which are?
Equities and fixed income. Or, in plain English, stocks and bonds.
Let's start with equities. When a beginner logs into a brokerage app and buys a share of stock, let's say a ticker symbol for a massive tech company or a national coffee chain, what are they legally and mechanically acquiring?
This is a huge point of confusion.
Are they just buying a digital token on a screen that goes up and down based on speculation?
That is a pervasive and dangerous misconception. A stock is not a speculative token. It is a legal claim of equity. When you buy a share of stock, you are purchasing a fractional, proportional ownership stake in a real functioning corporation.
So I am an actual part owner of the coffee chain.
Legally, yes. You own a microscopic slice of their espresso machines, their real estate leases, their brand and intellectual property, and crucially, their future cash flows.
That makes it feel so much more tangible.
It is tangible. The reason stocks generate high long-term returns is not because of arbitrary trading. It is because human beings go to work every day at these corporations, innovate, create new products, expand into new markets, and generate profits.
That is the engine of capitalism. The equity risk premium exists because equity holders, the owners, are the last to get paid.
Right.
If a company goes bankrupt, the bondholders and the banks get whatever assets are left. The stockholders are wiped out. Because we take on the maximum risk of ownership, we demand the maximum potential reward.
Exactly. Stocks represent your aggressive growth engine.
Yeah.
But because the value of that ownership stake is constantly being reassessed based on quarterly earnings, consumer trends, and macroeconomic data, equities inherently possess high volatility.
Which necessitates a shock absorber for the portfolio.
Yeah.
If equities are the engine, what is the suspension system?
That brings us to bonds.
Mechanically, how does fixed income differ from equity?
If buying a stock means you are an owner, buying a bond means you are a lender. You are operating as the bank.
I'm lending them my money.
Right. You lend your capital to an entity, a corporation, a municipality, or a sovereign government, like the U.S. Treasury, for a predetermined period of time.
And what do I get in return?
In exchange for the use of your capital, they enter into a legal contract to pay you a fixed rate of interest at regular intervals, and they promise to return your initial principal on a specific maturity date.
It's a contractual obligation. I am not banking on the company innovating a new product. I am just banking on their ability to pay their debts.
Precisely. Because bonds sit higher in the capital structure, meaning bondholders get paid before stockholders in the event of liquidation, they're significantly less risky.
So they provide stability.
They provide structural stability and yield to your portfolio. They generally will not match the exponential growth of stocks over long periods, but they act as an anchor when the equity markets experience violent turbulence.
This sounds elegant in theory. I want high growth ownership, which is stocks, and stable contractual yield, which is bonds.
Yep, that's the mix.
But practically speaking, as an everyday investor with maybe $100 a month to deploy, I cannot realistically research, purchase, and manage a portfolio of 500 individual stocks and 100 individual corporate bonds.
No, absolutely not.
The trading fees alone would devour my capital, and the concentration risk of picking the wrong 3 companies would be catastrophic.
And this was the historical barrier to entry for the retail investor until the advent of pooled investment vehicles, specifically mutual funds and exchange-traded funds, or ETFs.
ETFs. These tools democratized wealth building.
They completely changed the game.
Explain the mechanism of an ETF. How does it solve the diversification problem for the little guy?
Think of a mutual fund or an ETF as a massive, professionally managed container. The fund manager aggregates capital from tens of thousands of individual investors.
Okay, a big pool of money.
Right. They then deploy that massive pool of capital to purchase a deeply diversified basket of underlying securities, thousands of individual stocks or bonds.
So if I use my $100 to buy a single share of a total stock market ETF, I am instantly acquiring microscopic fractional ownership in thousands of distinct corporations simultaneously.
Exactly. You achieve instant, profound diversification with a single transaction.
Which is incredible.
It is. If one of those underlying companies goes bankrupt, the impact on your total portfolio is negligible because you own thousands of other companies that are thriving. It eliminates single company catastrophic risk entirely.
Now, the iShares guide focuses heavily on ETFs. What is the functional distinction between a traditional mutual fund and an ETF for a beginner?
Functionally, for a long-term buy-and-hold investor, they serve the exact same purpose. The difference really just lies in the plumbing.
Good plumbing, okay.
A traditional mutual fund is priced and transacted only once per day after the markets close. You buy it directly from the fund issuer.
And an ETF?
An ETF, as the name implies, trades on a public exchange exactly like an individual stock. Its price fluctuates throughout the trading day, and you buy it through a broker.
So it's more flexible.
Yeah, and ETFs also generally offer slightly better tax efficiency and lower internal costs, which has made them the preferred vehicle for modern portfolio construction.
Okay, so we understand the raw materials, stocks, bonds, and the ETFs that package them together. But a massive source of confusion in personal finance is where to actually hold these assets.
Oh, the alphabet soup.
Yes, we hear terms like 401k, IRA, Roth, TFSA, RSP. It sounds like impenetrable institutional jargon.
The terminology is dense, but the concept is vital to master because it dictates the tax drag on your compounding engine.
We need to rigorously separate the concept of the investment from the concept of the account.
Yes.
I want to introduce an analogy here to clarify this, but I want to move past the traditional grocery bag metaphor.
Okay, let's hear it.
Let's think of your investments, the ETFs, the stocks, the bonds, as highly sensitive electronic components. They are generating energy, compounding wealth.
I'm with you.
If you leave them out in the open, they are subjected to environmental interference, specifically taxation. Every time they generate a dividend or a capital gain, the IRS siphons off some of that energy, slowing down the compounding process.
The tax drag.
Exactly. So we need to place these components inside a protective environment. We need a financial Faraday cage.
I love that.
The accounts, 401ks, the IRAs, the TFSAs are the Faraday cages. They are not the investments themselves. They are the legal tax shelters built around the investments to block the interference of taxation.
That is a brilliant conceptualization because a staggering number of beginners make the tragic error of opening a traditional IRA, depositing cash into it, and assuming they are now, quote unquote, investing for retirement.
Oh, no. So they just put cash in the cage?
Yes. They have merely placed idle cash inside an empty Faraday cage. The cash is still being destroyed by inflation. It just isn't being taxed while it dies.
That's heartbreaking.
It is. You must explicitly use the cash inside the shelter to purchase the equities and fixed income.
Let's categorize these shelters. What is the fundamental difference between a standard brokerage account and these tax-advantaged cages?
Well, a standard taxable brokerage account is entirely unshielded. You have absolute liquidity. You can deposit and withdraw at will, but you will pay annual taxes on every dividend received and capital gains taxes on every profitable sale.
So the compounding process is constantly facing friction.
Exactly. But the government wants us to save for our own retirements, so they created incentives.
To reduce the burden on state welfare systems, right?
Precisely. They created legally codified tax shelters. In the United States, you have employer-sponsored plans like the 401k or 403b, and individual retirement accounts like the traditional and Roth IRA.
And what about Canada?
In Canada, as the TV guide details, you have the TFSA, which is the tax-free savings account, and the RSP, the Registered Retirement Savings Plan.
Let's look at the mechanics of the tax advantage. They generally fall into two camps, right? Tax-deferred or tax-free.
Correct. A traditional 401k or RRSP is tax-deferred. You receive a tax deduction on the money you contribute today, lowering your current income tax burden.
So I pay less taxes this year.
Right. The money grows completely untaxed for decades inside the shelter. The government only taxes you on the back end when you withdraw the money in retirement, presumably when you are in a much lower tax bracket.
Okay, and the Roth or TFSA model flips that.
Yes. In a Roth IRA or a 2FSA, you contribute after-tax dollars. You get no immediate tax break.
It hurts a little more today.
It does, but the money grows entirely tax-free, and crucially, all withdrawals in retirement are 100% tax-free.
Wow.
The government can never touch those gains again. It is arguably the most powerful compounding environment legally available to the retail investor.
We have to explicitly address the institutional anomaly of the employer match within the 401k system, because this is perhaps the only instance in capitalism where there is a genuine free lunch.
The employer match is an arbitrage opportunity that must not be ignored. Many corporations will match your contributions to a 401k up to a certain percentage of your salary.
Often 50 cents or $1 for every dollar you contribute, up to 3% or 5%, right?
Exactly.
If an employer offers a 100% match up to 5% of my salary, and I decline to contribute that 5%, what am I actually doing?
You are voluntarily taking a pay cut. You are leaving a codified part of your total compensation package sitting in the corporate treasury.
Just leaving money on the table.
Mathematically, an employer match is an immediate, guaranteed, risk-free 100% return on your invested capital, realized before the market even opens for trading.
There is no hedge fund on earth that can guarantee a 100% day one return.
Never. Capturing the full match is always step one of any rational financial plan.
Okay, the architecture is really coming together. We understand the tax shelters, and we understand the components, equities, and bonds that we need to put inside them. But how do we calibrate the machine? What is the ratio of stocks to bonds?
That calibration is referred to as asset allocation. It is the architectural blueprint of your portfolio.
And how important is it?
Unbelievably important. Numerous academic studies have demonstrated that your specific asset allocation, the macro ratio of stocks to bonds, will dictate over 90% of your portfolio's long-term volatility and return profile.
Wow, 90%.
Yes, it matters significantly more than the individual ETFs you select.
So how does an uninitiated investor determine their optimal allocation? Do we just guess?
No, it is entirely dictated by the intersection of your time horizon and your behavioral risk tolerance.
Give us an example.
Okay, take a young investor in their 20s or 30s, investing for a retirement that is 3 to 4 decades away. Their time horizon is massive, and their need for current income is zero.
Right.
Therefore, a purely rational mathematical approach dictates a heavily aggressive allocation to capture maximum long-term growth.
So an 80-20 or even a 90-10 split in favor of equities.
Exactly. 80 to 90% deployed into broad global equity ETFs, and 10 to 20% in fixed income to provide a psychological buffer during market crashes.
But let's be realistic. Managing that ratio, monitoring it, and making manual adjustments, that might still feel like too much friction for someone who just wants to live their life.
Oh, definitely. People get busy.
If I want a completely hands-off, automated solution that manages my risk profile for me over the next 40 years, what is the mechanism?
The financial industry actually did innovate one truly brilliant product for this exact problem, the target date fund.
Unpack the mechanics of the target date fund for us. How does it manage risk dynamically?
A target date fund is a comprehensive, all-in-one mutual fund or ETF designed to be the only holding in your portfolio. You select the fund with the year closest to your anticipated retirement date.
So, for example, a 2060 target date fund.
Exactly.
So it's essentially a pre-packaged portfolio with a specific expiration date.
Correct. And its genius lies in a mechanism called the glide path.
The glide path.
Right. When the year 2060 is decades away, the fund manager automatically sets the internal asset allocation to be highly aggressive, perhaps 90% equities and 10% bonds, because you have the time to recover from severe market downturns.
Makes sense.
But as the calendar marches forward and you approach the target date, the fund manager dynamically alters the allocation.
Automatically.
Automatically.
Okay.
They systematically sell off equities and purchase more fixed income. By the time you reach 2060, the portfolio might be 60% bonds and 40% equities.
So it automatically de-risks my portfolio as my time horizon shrinks, protecting me from a catastrophic market crash right on the eve of my retirement.
Exactly. It essentially solves the asset allocation problem entirely.
It removes the behavioral burden of portfolio management. You simply contribute capital, and the fund executes the macroeconomic strategy.
It's fantastic for beginners.
That is the ultimate set-it-and-forget-it strategy. Now, the Western and Southern Guide does detail various distinct investing styles for those who want to look under the hood of the equity markets.
All right. It discusses growth, value, and income investing.
Yeah, but I want to bypass those micro-strategies for a moment to focus on the most consequential philosophical divide in modern finance: active versus passive management.
Ah, yes. That is the dividing line of modern portfolio theory.
Active management is the traditional Wall Street narrative. You pay a highly credentialed fund manager a substantial fee, and they utilize their expertise, their analysts, and their algorithms to analyze thousands of companies.
And their objective is to handpick the best stocks, buy them at the right time, and essentially beat the average return of the overall market.
Which sounds highly logical. I mean, if I want a good house, I hire an expert builder. If I want good returns, I hire an expert stock picker. Why is this logic flawed?
It is flawed because the stock market is not a house. It is a highly efficient, hyper-competitive, zero-sum information processing machine.
Right.
For an active manager to beat the market, they must possess information or analytical capabilities that the rest of the institutional world does not have, and they must be right consistently over decades.
William Sharpe's arithmetic of active management comes to mind here. Before costs, the return of the average actively managed dollar must equal the return of the average passively managed dollar, because together they make up the entire market.
Exactly.
But after costs, the active manager must fundamentally underperform.
Precisely. And the empirical data validates Sharpe's arithmetic brutally.
Like the SPVA scorecards.
Yes. Study after study, most notably those SPVA scorecards, demonstrate that over long time horizons, 10, 15, 20 years, upwards of 90% of highly paid professional active fund managers fail to outperform their respective passive benchmark indices.
90% failed to beat the market. That's insane. So what is the passive alternative?
Passive or index investing concedes that the market is too efficient to consistently outsmart. Instead of paying an expert to search for the needle in the haystack, the passive investor simply buys the entire haystack for pennies.
Buy the haystack.
You purchase an index ETF, like one tracking the S&P 500, or a total global market index. The ETF simply holds every company in the market, capitalization weighted. You capture the exact return of global capitalism minus an infinitesimally small fee.
The passive route is empirically superior, requires less effort, and costs less.
The win-win-win.
Which leads us to the deployment of capital. Let's say I've accepted the passive index fund strategy. I want to buy the haystack.
Okay.
Do I stockpile my cash until I have a massive lump sum of $10,000 and then try to deploy it on a day when the market looks cheap?
No, absolutely not. That is reverting to market timing, which we have already established as a behavioral trap.
Right. So what's the strategy?
The systematic execution strategy you need is dollar cost averaging.
Let's dissect dollar cost averaging. It sounds like accounting jargon, but it's actually a profound behavioral nudge.
Dollar cost averaging, or DCA, is the practice of investing a fixed, predetermined dollar amount at regular, set intervals, completely irrespective of the current market conditions.
So I commit to buying $500 worth of my total market ETF on the 1st and 15th of every single month, regardless of whether the financial news is euphoric or apocalyptic.
Exactly. And while there is academic debate about whether DCA is mathematically superior to immediate lump sum investing in a purely upward trending market, DCA is undisputedly the superior behavioral strategy for an investor accumulating wealth from a paycheck.
Because it forces mechanical discipline against human emotion.
It naturally enforces the cardinal rule of investing buy low without requiring any active decision-making.
How does it do that?
Think about it. When the market crashes and prices are depressed, your fixed $500 automatically acquires a larger number of shares.
Oh, right, because they're on sale.
Exactly. And when the market hits all-time highs and assets are expensive, your $500 acquires fewer shares. Over a multi-decade time frame, this mathematically smooths out your average cost per share.
And entirely eliminates the paralyzing anxiety of trying to deploy capital on the perfect day.
Completely eliminates it.
We have our passive index strategy, and we are dollar cost averaging automatically. It feels bulletproof.
It's a great setup.
But even a perfectly designed engine will fail if there is a structural leak in the fuel line. And that brings us to the hidden traps that silently destroy wealth.
Yes, the pitfalls.
If I am looking at the data from the ATI guide, the most insidious threat to a long-term investor isn't market volatility. It is the compounding destruction of institutional fees.
Fees are the silent counterpart to compounding interest. Just as your returns compound exponentially in your favor, the fees you pay to Wall Street compound exponentially against you.
Let's unpack the math on this because human beings are terrible at contextualizing small percentages.
Very true.
When a beginner looks at a mutual fund prospectus and sees an expense ratio of 1% or 1.5%, their brain categorizes that as negligible. I mean, if I leave a 1% tip at a restaurant, I am a terrible tipper. It sounds like a rounding error.
Right, it sounds tiny.
How catastrophic can a 1% fee actually be?
It is catastrophic because the fee is deducted not just from your initial principal, but from your total accumulated balance every single year, regardless of whether the fund makes money or loses money.
Oh, wow.
You are paying a percentage of your total wealth for the privilege of holding the asset.
Let's look at the chilling data point provided by ATI to quantify this.
Okay, assume you have a $100,000 portfolio and you leave it invested for 30 years, assuming a gross return of 8%.
Okay, base scenario.
If you invest in a passive index fund with a minimal expense ratio of 0.05%, your portfolio grows to roughly $930,000.
930 grand. That is the pure power of the compounding engine.
Now assume you invest that same $100,000 in the exact same market, but you utilize an actively managed fund with an expense ratio of 1.05%, exactly 1% higher.
Just 1% more.
After 30 years, that portfolio grows to only about $715,000.
Wait, pause on that math. A seemingly invisible 1% fee cannibalized over $200,000 of final wealth.
Yes. You surrendered more than a fifth of your total potential net worth to cover the administrative overhead of a fund manager who, statistically, probably underperformed the index anyway.
That makes me sick to my stomach.
You didn't just lose the 1% fee in year one. You lost the decades of compounded exponential growth that 1% would have generated if it had remained invested in your account.
The tyranny of compounding costs. This is the primary reason why low-cost passive index funds dominate long-term wealth creation.
The mandate is absolute ruthlessly hunt down and eliminate high expense ratios.
What are the other structural pitfalls beginners face?
The lack of true diversification is a major hazard. This often manifests when investors conflate brand affinity with sound investing.
What do you mean?
They love a specific smartphone or a charismatic CEO of an electric vehicle company, and they allocate a massive portion of their net worth into a single corporate equity.
The classic concentration risk, putting all your chips on one number.
Exactly. If that single corporation encounters a massive regulatory hurdle, an accounting scandal, or a paradigm-shifting competitor, the stock price can collapse permanently.
But true diversification owning the total global haystack means that individual corporate failures are instantly offset by the successes of thousands of other entities.
Yes, you capture the systemic growth of the economy while insulating yourself from single-point failures.
Let's assume we've dodged the fee trap, we are broadly diversified in our ETFs, and we are dollar-cost averaging into our tax shelters. The system is running.
Sounds good.
Does it require manual maintenance? Do we just walk away for 30 years?
Well, a static portfolio in a dynamic market will eventually become misaligned. It requires a periodic mechanical recalibration process known as rebalancing.
Let's explore the mechanics of rebalancing. Why does a portfolio drift?
Let's revert to our foundational asset allocation. You establish a strict target of 80% equities and 20% bonds.
Right, our 80-20 split.
You execute this plan. Then, the global economy experiences a massive multi-year bull market in technology and equities.
Okay, stocks go on a run.
Your stock ETFs surge in value by 40%, while your bond ETFs remain relatively flat, just generating steady yield.
So because the stocks grew disproportionately faster, they now represent a much larger slice of the total pie.
Exactly. At the end of that bull run, you check your portfolio and your mathematical allocation has drifted. It's no longer 80-20, it is now 92% equities and 8% bonds.
I understand the math, but behaviorally, why is that a problem? The stocks are the winners. Why wouldn't I want to hold more of the asset that is making me rich?
Because your portfolio's risk profile has fundamentally altered without your explicit consent. A 92% equity portfolio is significantly more volatile and vulnerable to a massive drawdown than an 80% equity portfolio.
Oh, I see.
You are suddenly exposed to a level of structural risk that exceeds your initial time horizon and behavioral tolerance.
So I have to rein in the winners to protect the structural integrity of the portfolio.
That is the essence of rebalancing. Annually or semi-annually, you assess the drift.
And then what?
To restore the 80-20 target, you must execute a specific set of trades. You sell off a portion of your overperforming asset class, the equities, and use those proceeds to purchase more of the underperforming asset class, the bonds.
It's structural maintenance. It's exactly like taking your vehicle in for a front-end alignment.
That's a great way to look at it.
You drive for a year, you hit inevitable potholes, the terrain causes the chassis to shift, and the car slowly begins to pull to the right. Rebalancing is putting the car on the rack and resetting the steering geometry back to center so you don't gradually drift off a cliff over the next decade.
It is a precise analogy. And crucially, rebalancing forces you to execute the ultimate contrarian investing maneuver. It mathematically forces you to sell high and buy low.
Oh, wow. Yeah, it does.
You are stripping profits from the expensive asset and deploying them into the cheap asset, entirely devoid of emotion.
And as we discussed earlier, if you utilize a target date fund, this alignment process is executed internally by the fund manager on a continuous basis.
Exactly. You don't even have to think about it.
Which brings us to the crescendo of this entire analysis. We have mapped the terrain. We understand the mathematics of inflation and compounding.
They covered a lot of ground.
We have deconstructed the psychology of loss aversion and market timing. We've defined the instruments, ETFs, stocks, bonds, and the tax-sheltered Faraday cages we place them in.
Right.
We know how to evade the fee traps and rebalance the machine. Now the mandate is execution.
Let's get to it.
If a listener is absorbing this, understanding the theory, but is staring at a blank screen wondering, what is the exact chronological sequence of actions I take to initiate this? We need to outline the definitive, actionable roadmap derived from these institutional guides.
The ATI guide actually provides a phenomenal, highly sequential 6-point operational framework. It is designed to mitigate risk and automate wealth creation systematically.
Let's walk through the architecture of this plan.
Okay, step one is defining the architectural blueprint. Set a clear goal and an explicit timeline.
Why is that step one?
Because capital deployed without a specific purpose is highly susceptible to emotional panic. Are you investing to fund a retirement in 2055? Are you building a down payment for a house in 2030?
You need a target.
Defining the objective dictates the time horizon, which in turn dictates the asset allocation. It anchors the capital.
It provides the psychological why that will prevent you from liquidating the portfolio during a bear market. I love that. What's step two?
Step two addresses the foundation. It is absolute risk mitigation. Build the liquidity buffer and neutralize toxic debt.
Before investing.
Before you aggressively deploy capital into the volatile equity markets, you must construct a defensive moat. This means accumulating 3 to 6 months of essential living expenses in a highly liquid, boring, guaranteed bank account.
But wait, this goes back to our discussion on savings versus investing. We know the cash in that bank account is being eroded by inflation. Why accept that guaranteed loss?
Because the opportunity cost of not having it is catastrophic.
Give me an example.
If a macroeconomic shock hits a recession that causes both a 30% drop in the stock market and the loss of your employment, you need immediate liquidity to survive.
Ah, I see.
If you do not have a cash moat, you will be forced to liquidate your equities at the exact bottom of the market crash just to pay your rent. The cash buffer protects the compounding engine from premature liquidation.
That makes total sense. And the debt.
Concurrently, you must eliminate high-interest consumer debt, like credit cards bearing 20% interest rates. No rational investment portfolio will consistently yield a return that outpaces a 20% compounding drain on your balance sheet.
The moat is built. The toxic debt is neutralized. Step 3 is opening the right accounts.
Step 3 is maximizing structural efficiency. Utilize tax-advantaged accounts and capture institutional arbitrage.
Grab that free lunch.
Exactly. If your employer offers a 401k or similar vehicle with a matching contribution, you must direct capital there first to capture the 100% immediate return of the match.
And after that?
Once that arbitrage is exhausted, pivot to IRAs, Roth options, or in Canada, the TFSA and RRSP, to ensure your compounding engine is shielded inside that tax-free Faraday cage.
Step 4 is filling the cage.
Step 4 is asset deployment. Construct a simple, brutally low-cost portfolio. Do not attempt to analyze individual corporate balance sheets.
No stock picking.
Do not purchase speculative assets based on social media trends. Acquire a broadly diversified equity index ETF and a fixed income ETF, or deploy 100% of the capital into a target date fund corresponding to your objective timeline.
And check those fees.
Scrutinize the prospectus and ensure the expense ratio is a fraction of a percent.
Step 5 is where behavioral economics meets execution.
Step 5 is the operational linchpin. Automate the system entirely.
Automate it.
Human discipline is a finite and fragile resource. If you have to make a conscious manual decision to transfer money into your investment account every month, you will eventually fail.
You will prioritize a vacation or a new gadget instead.
You must coordinate with your payroll department or your brokerage to automatically extract a percentage of your income, start with 5 to 10% the moment it hits your checking account, before you ever perceive it as available capital.
This leverages Richard Thaler's behavioral nudges. By automating it, you remove the friction of choice. The default state becomes wealth accumulation rather than consumption. And finally, step 6.
Step 6 is periodic maintenance. Revisit and rebalance annually.
Just once a year.
Select an arbitrary, memorable date, your birthday or the first week of the new year. Spend precisely 1 hour auditing the system.
What am I checking for?
Verify that your contribution rates are still optimal, ensure your expense ratios haven't crept up, and if you are managing individual ETFs, mechanically rebalance the portfolio back to your target asset allocation to manage the structural risk.
I want to highlight the most profound realization embedded within this 6-step sequence. The actual labor of investing is almost entirely front-loaded.
Completely.
Steps 1 through 5 are architectural decisions. You spend perhaps one intense weekend building the moat, opening the accounts, selecting the low-cost indices, and establishing the automated routing of capital.
And then you're done.
Once that infrastructure is live, the day-to-day reality of being an investor requires absolutely zero cognitive effort. You go to work, you focus on your family, you live your life, while the automated engine in the background relentlessly aggregates shares and captures the compounding growth of global capitalism.
That is the zenith of personal financial engineering. You are not striving to become a part-time day trader. You are building a mechanized, emotionless system that leverages time to do the heavy lifting for you.
So synthesizing everything we have unpacked from ATI, iShares, Western and Southern, and TD Canada Trust, the overarching paradigm shift is this.
Lay it on us.
Investing is not an elite, complex sprint designed for financial savants. It is a slow, methodical, highly accessible marathon.
Yes.
It requires you to respect the destructive force of inflation, embrace short-term volatility as the price of long-term growth, ruthlessly eliminate institutional fees, and automate the mechanics to protect yourself from your own evolutionary psychology.
You do not need absolute mastery to begin.
Yeah.
You do not need a massive reserve of initial capital. You simply need the humility to accept market returns and the discipline to start the compounding clock immediately.
Which brings us to the definitive call to action for this deep dive.
The most important thing you can do today.
If you have been paralyzed by the sheer volume of jargon or convinced that your current income doesn't justify the effort, your immediate imperative is to break that inertia today.
Today, not tomorrow.
Open a low-cost brokerage account or access your corporate HR portal. Select a globally diversified index fund or a target date fund, and commit an amount of capital that you'll not even feel, whether it is $100 or simply $25 a paycheck.
$25.
Set up the automated transfer, initiate the sequence. The absolute dollar amount is secondary. Starting the temporal engine of compounding is paramount.
Establishing that automated habit is unequivocally the highest leverage action you can take to dictate your future economic autonomy.
I want to leave you with one final structural thought to analyze as we close.
Okay, let's hear it.
Throughout this entire exploration of asset allocation, tax shelters, and compounding math, one variable consistently emerges as the ultimate determinant of success.
Time.
It is not your intellectual capacity to pick stocks, and it is not even the sheer magnitude of your starting salary. It is time. Mathematically, a mediocre investor with 3 decades of time will utterly obliterate a brilliant investor with only 1 decade.
It's the one asset that cannot be engineered, borrowed, or retroactively acquired.
Exactly. So if we accept that time is mathematically your most potent financial asset, your ultimate wealth-generating engine, how does viewing time itself as your primary currency fundamentally alter the way you evaluate every single financial decision you make today?
That changes the perspective entirely.
Every dollar you aggressively consume right now is not just a dollar spent. It is the permanent destruction of the future time that compounded dollar could have purchased for you.
Wow.
The objective of investing is not to accumulate capital for the sake of appearing wealthy today. The objective is to deploy your capital to systematically buy back your own time, your own autonomy in the future.
I couldn't have said it better myself.
Don't let the noise, the complexity, or the jargon delay that process for another day. Initiate the sequence, let the engine run, and reclaim your future.
Thanks for tuning in to All Things Investing. Don't forget to subscribe so you never miss a tip that could boost your financial future. Follow us on TikTok, YouTube, and wherever you get your money advice. Until next time, keep investing in yourself. Financial disclaimer. The information provided on the All Things Investing podcast is for educational and informational purposes only. It is not intended as financial, investment, tax, or legal advice. Always do your own research and consult with a licensed financial advisor or other qualified professional before making any investment decisions. The views and opinions expressed are those of the host and guests, and do not constitute official recommendations. Investing involves risk, including the potential loss of principal. Past performance is not indicative of future results. By listening to this podcast, you agree that the host and associated parties are not responsible for any financial decisions you make based on the content provided.